5 years. That's how long it's been since analysts revised S&P 500 earnings estimates this aggressively upward, and most investors are completely asleep at the wheel right now. Here's what's really going on, and what you should be thinking about right now. The S&P 500 is rallying. Headlines look great, but peel back one layer, and the picture gets uncomfortable fast. Bloomberg is raising alarm bells. This rally, it's being carried by a handful of stocks, not the broad market, a handful. We're talking about the top 5 to 10 names in the index doing the heavy lifting, while hundreds of other S&P 500 components are lagging behind or going nowhere. Analysts are already drawing direct comparisons to the dot-com bubble of the late 1990s. Narrow leadership, euphoric sentiment. Sound familiar? Goldman Sachs just issued a blunt warning to equity investors. They're not whispering. They're putting it on the table. Concentration risk is real and it's building. And here's where it gets genuinely confusing. FactSet is confirming the largest upward EPS estimate revisions for the S&P 500 in 5 years. Earnings expectations are surging. So which signal do you trust? Bullish earnings revisions on one side, dangerously narrow market leadership on the other. That divergence is the story nobody is connecting right now. But here's what nobody is saying about this yet. If you're sitting in a standard S&P 500 index fund, you are not as diversified as you think you are. You are, functionally, making a concentrated bet on 5 to 10 mega-cap names, whether you realize it or not. The index is top-heavy, and a rotation or a pullback in those leading names doesn't just hurt those stocks. It drags the entire index down with them. That's the hidden risk hiding in plain sight inside your diversified portfolio. First, pull up your current holdings and check your actual exposure to the top 5 to 10 S&P 500 names. Know your concentration before the market forces you to care about it. Second, consider researching equal-weight index alternatives. Equal-weight S&P 500 strategies reduce single-stock concentration risk structurally. That's worth understanding right now. Third, those EPS revisions matter. Strong earnings revisions can support valuations, but elevated valuations in a narrow leadership environment demand tighter risk management. Don't chase momentum blindly. Massive earnings revisions, dot-com comparisons, a Goldman Sachs warning, 3 signals pointing in 3 different directions at the same time. What do you think this means for your portfolio? Drop it below. The most interesting take gets pinned. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions.